COVID-19, more commonly known as the coronavirus, is obviously a devastating virus, having now killed approaching 2,900 people, infected just over 83,000, and spread to at least 48 countries. And while the death rate is still relatively low, with only around 2% of those infected dying from the virus, the human impact is obviously absolutely tragic. However, in this video, we're going to take a look at another side of its impact. The effect the coronavirus has had on the global economy, and the carnage a virus like this could cause to markets all over the world. Before we dive in, I wanted to mention our US channel. You might already know about TLDR US, where we're covering the Democratic primary, as well as other major stories happening across the pond. Well, as you'll soon discover, the US economy has been hit particularly hard by the coronavirus thus far. So if you're interested in that, you might want to check out our video about Trump's economy. The president likes to talk a lot about the wonders he's done economically, so we decided to take a look at it and see if he's really made the impact he thinks he has. Check out that video and all of our other US content by clicking the link to the channel below. As we just alluded to, the stock markets in the US and around the world have already been hit hard by the coronavirus. The Dow Jones Industrial Average, or just the Dow, is the stock market which contains 30 of the US's biggest companies. The Dow fell by 1,190 points in a single day last week. This was a 4.4 percentage point drop in one day, marking the biggest one-day fall in the market's history. Trump has so far downplayed the impact of the virus, insisting that factors caused by General Motors, Boeing, and the Federal Reserve have had a greater impact on the economy. But Goldman Sachs is already warning of the economic impact across the whole US economy, expecting the US's GDP to fall by 0.8% in the first quarter, before recovering in the second quarter. A similar thing happened in the UK, with the largest stock market, the FTSE 100, falling by 3.5%, marking the worst week in the FTSE since the 2011 EUROZONE debt crisis. The practical impact of this might be a sharp drop in the market caps of some companies, with Apple dropping by over 40 points in 1 week, Microsoft by 20, and Goldman Sachs by 25. But this has all been caused by wider fears within the market. As the virus continues to spread, investors have begun to grow worried about the longer-term impacts of the virus, and how the global economy will fare in months to come. That's because, in an attempt to control the virus, governments and companies are taking pretty drastic action. Exactly the kind of thing which spooks markets. That's action ranging from the Australian travel ban, which bans trips to China, school closures across Japan and the world, major conferences being cancelled, including Facebook's annual developer conference and Mobile World Congress, or even the postponement of games in the Six Nations rugby tournament. The problem that ties all of these together is uncertainty. It's very possible that these moves could limit the spread of the disease and prevent a major economic downturn. But investors are becoming increasingly concerned about the effect that COVID-19 is having across the world. Speaking of The Guardian, head of global economics at consultancy Capital Economics, said, "One thing becoming clear is that we just can't predict the spread of this and how bad it will be. But it's not difficult to get something similar to the 2008 crisis with a pandemic situation. Of course, we hope it won't get that bad. The real concern is if this outbreak gets even worse, businesses may be forced to cease trading worldwide, and there's very little governments or markets can do to prevent the downturn that this would cause." As the Deputy Governor of the Bank of England, John Cunliffe, put it, "If it's a pure adverse supply shock, there is not much monetary policy can do. Essentially, if goods and services stop being produced and businesses stop operating as normal, there's not a whole lot that monetary policy can do to stabilise the situation." And as we're already seeing, this is starting to play out in some parts of the world, with some factories in China having been closed for weeks. In fact, and this isn't even a promo for us, if anything it's the opposite, our pin badge supplier has been closed for weeks, meaning that some of our orders have been significantly delayed. Don't worry, we've notified everyone affected, but it's a tiny example of how these closures affect businesses all over the world. In fact, somewhat ironically, the same is true for RB. Despite demand increasing for their disinfectants like Dettol and Lysol, their maker says that they're facing supply chain and distribution issues following the outbreak. But the greatest impact of these closures has obviously been in China. Towards the beginning of the month, Chinese economists warned that the coronavirus could reduce the country's GDP growth by up to 1%. A significant drop, which Zheng Gang, vice chair of the National Institute for Finance and Development, compared to the 2003 SARS epidemic, saying that in the short term, the epidemic's impact on economic activity cannot be ignored, especially with tertiary industries and small enterprises with tight cash flows facing greater pressures. And he's not the only one making the prediction, with many expecting a wave of bankruptcies in China following the outbreak. A wave which could affect not just business owners and investors, but also drive up unemployment. Looking around the world though, it's clear that the impact is spreading down the production line. An economist from the University of Chicago's Booth School of Business said that with Chinese business activity at 20% of normal rates, the effects on American growth will be huge, even in the best case scenario of the virus. Many companies in the aviation and tourism industries are already reporting problems, following issues in the market, concerns about flying, and travel bans. Microsoft and PayPal have also forecasted disappointing profits for the year ahead, with Microsoft blaming supply chain issues in their PC business. Apple have reported similar issues, with their reliance on Chinese supply chains and customers set to impact the company's bottom line. Even AB InBev, owners of a range of alcohol giants, including Corona, reporting a $170 million drop in profits. While unemployment and business profits might be an issue, the real concern is how these suffering companies will impact the major banks. That's because over the last few years, global debt levels have spiraled, with the International Monetary Fund raising the issue on multiple occasions in recent months. According to the IMF, this could lead to the global economy facing a $19 trillion corporate debt time bomb. That might sound like hyperbole, but there's genuine concern about how high levels of corporate debt and a crisis like the coronavirus could impact the global economy. The IMF have warned that because central banks all over the world have encouraged companies to borrow more in the aftermath of the 2008 financial crisis, many companies would be unable to pay back their debts if another recession hit. In fact, in their 2019 update, they stated that 40% of corporate debt held by 8 leading countries would be impossible to service if there was a downturn even half as serious as the 2008 financial crisis. This means that if businesses do seriously begin to struggle, they might not be able to continue paying back their loans. If enough businesses have this problem, then it would seriously impact the world's largest banks, who rely on companies' repayments. It's easy to see how these struggling companies who fail to pay back their loans would eventually hit the banks hard. And as we saw in 2008, the real problems begin when banks start to fail. And all this isn't hypothetical. The Chinese central bank recently conducted a stress test of the country's biggest banks and found that up to 17 of the biggest 30 would collapse if economic growth dropped to 4.15%. And while a drop that large is far from certain, it does illustrate quite how at risk some countries, industries, and institutions could be. The thing is, and as we mentioned earlier, it's all about uncertainty. The same factors that have spooked the market, the travel bans, the closures, the cancellations, could very well be the things which help stop the virus's spread and prevent coronavirus from having major impacts on the global economy. At the moment, all governments can do is try and stop the spread of disease. And despite the market's concerns, this could be successful, preventing the exact damage that the market is scared of. In fact, speaking on Sunday, the head of the International Monetary Fund told finance leaders and central bank chiefs that the IMF assumed the impact to be relatively minor and short-lived, but it did emphasise that if there was a continued spread of the virus, it could have dire consequences. Going on to say that global cooperation is essential to the containment of COVID-19 and its economic impact, particularly if the outbreak turns out to be more persistent and widespread. Time will tell if the virus's spread will continue, or if governments will be able to contain its growth. And from that, time will also tell the ultimate impact it will have on the economy. Let us know your thoughts in the comments below. Are you concerned about the coronavirus's spread? Do you think that it will damage the global economy? Let us know your comments or join the conversation over on Discord. We'll continue to update you on this and a variety of other news topics, so be sure to subscribe to the channel for more updates and hit the bell icon to be notified whenever we post. You can also find us across other social networks simply by searching for TLDR News.